How can you get the most out of your money during retirement? Today, we're going to look at a case study which involves someone who has a decent sized nest egg set aside for retirement. However, they're afraid to spend that money because they want to leave it to their children. So the question is, how do I spend my money now so I'm comfortable during my retirement and at the same time leave the legacy that I want to? I'll go over exactly how we do this, all without any stock market risk. So what we have is someone who is 61 years old. They have an account with about $750,000 in it. Now their goals are as follows. One, they want to leave this money to their children. And two, they'd like to be able to take income. However, they're nervous to spend this money because they know if they touch it, now they're going to leave less to their children. A lot of people feel stuck here. I've got this sum of money. I'm really nervous to spend it. Maybe I'll just live on Social Security and other sources of income that I have. So the question is, how can I have both specifically without any market risk? That's the big thing, meaning I don't want to risk losing money and then have everything fall apart. So what we're going to look at here are guaranteed insurance products. What we'll look at is first, a guaranteed income annuity, and then second, a whole life insurance policy specifically set up for high cash value, but I'll go through exactly how we leverage these two. So here are the steps that we're going to take, and the numbers will look pretty cool when we tie everything together. So we're going to move that $750,000 into an annuity. He's 61 right now, so 12 months from now, when he's 62, the annuity is going to produce income of a little bit more than $60,000 per year. This is the guaranteed income payout. So if we look at the annuity illustration that we just ran, it's assuming that he deposits $750. You can ignore that $840. But that $750 at 61 deposits, and at 62, it'll guarantee him $61,740 per year for the rest of his life. So we're going to focus on this specific annuity. Okay. What we're going to do though, because he doesn't need the income right now, he'd like to be able to spend it or like to have some income, but he'd still like to be able to leave it to his children. So from 62 through 70 for 8 years, we're going to use that $60,000 that is being produced from the annuity to fund a whole life insurance policy. Then what you'll see is his life insurance policy on day one is going to be worth $750,000. And if he dies, that $750,000 is paid 100% income tax-free to his beneficiaries. What does that do right there? That goal of leaving money to his children is satisfied now. He's taken his $750,000, put it into a life insurance policy. We haven't even hit on the cash value yet, but now that death benefit is going to be paid income tax-free to his beneficiaries. So the legacy piece is solved now. And then at age 70, what we're going to do is stop funding the policy and then take that $60,000 per year and do whatever you want with it. He can live on it. He's got extra income in addition to his other income sources now. So here we go. The question is, how much did my $750,000 produce? Specifically, how much did it produce for me in total income and cash value, because the cash value is his money that he can access? And then how much did it produce for my children? Because while it started at $750, it didn't stay there. It grew over time. Let's take a look. We'll look at the numbers, and then we'll fill out the numbers, the figures we have on the whiteboard. So this was the annuity illustration. If he starts income 12 months from now, his guaranteed income will be just over $61,000. So the life insurance policy, we're going to fund it for how long? 8 years, starting at 62 through age 70, until age 70. So through age 69. Here's the funding here, $60K per year. So the annuity is producing a little bit more than 60. We just rounded down to make it a clean number. So you've got your cash value, death benefit at $750, all that good stuff. Let's look at everything side by side though. We're gonna make this a bit easier. I love this stuff. This is like so cool. All right, so what we have first is the annuity. What's going on here? There's the transfer or deposit of $750,000. He's doing this at 61. He's not taking income at 61, so he's deferring it for 12 months. Then at 62, so 12 months and 1 day, he's going to flip the income switch on, which if he takes it monthly will be $5,100. If he takes it yearly, it's 61, almost $62,000. And this is an annuity with a guaranteed income rider. So the income is guaranteed for the rest of his life, which is sweet. No risk, no management, very, very clean. What we're going to do though, is he doesn't need the income initially. Remember that for the first 8 years, so 62 through 69, this $60,000 and change, what are we gonna do with it? Move it into the policy. All right, remember the life insurance illustration we looked at? So we're taking this and moving it into this. So here's our funding for 8 years. Here's the total amount you've paid into the policy. Keep this number in mind. $480,000. After that, he pays nothing forever. So zero out of pocket. And then what happens with the cash value? Continues to grow. What happens to the death benefit? Stays level at $750 for a few years, but then it continues to grow over time. The cash value, is that money you can access? Yes, you can access it very easily. In his particular case, he could take out withdrawals, especially after the funding period. A withdrawal is just like withdrawing money from a bank account. There's no loan interest or anything like that. However, if you do take withdrawals, you will see an impact on the death benefit, or you could take out loans and you don't have to pay them back or pay the loan interest, provided we don't take the maximum loan. That could be a case where we have to pay something. But my point is, it is very easy to access this anytime he wants. If you request funds, it typically hits your bank account, direct deposit in 3 to 5 business days. So it's liquid. He's got cash growing for him. What do the totals look like? Let's look at that. So here's what we're going to look at. Total annuity payments. This takes the $61,000 and change per year that you're receiving and just tallies them up. So every year I add $61,740 to my total income payment. I can see the cash value growing because that's my money, or in this case, his money that he can access for whatever he'd like. And then I see the legacy piece, the death benefit, that again is paid out income tax-free when he passes. So we wanted to look at what? Do you remember the whiteboard? Age 85 and age 90. In his case, he did say, I have a lot of longevity in my family. So we're going to look at 85 and 90 years old. So as we scroll down a little bit, here we go. The big numbers are what we want to look at. We made them big on purpose. And let's just focus on the far right, shall we? Because this gives us our totals. Okay. So at 85, the total payments we received from the annuity, $1,481,000. Our cash value, just about $1.1 million. And our death benefit is almost $1.2. If we die, only the death benefit is paid out. So the death benefit, you'll notice, grows, but it grows with the cash value. The cash value growth is pushing that death benefit up. If we make it to 90, we see a lot there. So let's button all this up so we can just highlight the value that he saw here and why this strategy works very, very well for people that don't want to take on any risk with the market. So total income by age 85, what was that? It was $1.48 million. So 148 was like 481. We're just going to round off here. 1.48 million. The whole life policy funding, what was that? Meaning what was the total amount he paid into that policy, which came from the total income? 480,000. The 60K for 8 years. What was the cash value at 85? Just about $1.1 million. So what that means is that 480 that he used from the income from the annuity to fund the policy, if he's just focusing on the cash value that he wants to use and not leave any money, well, he's got $1.1 million there. That's appreciated over time. And then what's the life insurance benefit? How about that figure? Well, the life insurance benefit was just shy of $1.2 million. It's like 1.18. So I'm just going to round here. But remember, that's paid income tax-free. Now, if he makes it to 90, the total payments, if we just round off here, are about 1.8 million that he received from the annuity. The life insurance, the funding is exactly the same because he only funded it for 8 years. He could pay in more if he wants to. The cash value was just about 1.4. See what's going on here. And then the death benefit at 90 was 1.45 million. They get closer and closer to each other, the cash value and death benefit, as time passes. When you look at illustrations at age 100, they're typically the same. But with this strategy, he started with what? $750,000. So $750,000, if we just focus on age 85, gave him $1.48 million of total income payments. He turned that into more because he's got cash reserves on top of that. But then also, he left 1.2. So if we just take the 1.48 and the 1.2, round that up to 1.5 for simple math, what would that be? That'd be $2.7 million. So he turned the 750 into 2.7. What if he makes it to 90? Then what happens? Well, he started with what? The same 750. Total income was what? $1.8 million. Death benefit was $1.45 million, which comes out to what? $3.25 million when we add those two up. So the 750, he got a lot of value out of that. And what's driving this, by the way, is the annuity payments, because they're guaranteed, they're very predictable, and then he can do whatever he wants to do with them. But with his specific goals of being able to leave money to the children, that's where the life insurance policy really made sense, because it's paid out income tax-free. And what I just love about this strategy is we're not just paying a big premium into a policy. He has a lot more money in cash value than what he's paid into the policy, and he could use that tax-free the whole time as well. So this strategy I absolutely love. I would love to hear if you love it too, or what your thoughts are on it. Feel free to leave any comments below. If you have any questions, feel free to DM me, or you could reach out to us through our website or email as well. And as always, I hope this helps. Thanks so much for watching.